Hello, everyone. Welcome to the Imprint Explained. And we're looking at a new crisis that has struck the mutual fund area or the sector of our Indian economy. And in this series, we'll talk about what Franklin Templeton winding up the credit funds means to investors. We'll briefly start with the definition of mutual fund and then go about it. And we'll talk about should investors worry about their money in credit funds and other fund houses. What does Morgan Stanley say? What is UK Sinha's opinion? Right. Let's start. So just to have a definition, right? So what are mutual funds, right? So I know a lot of you might know about them, but still, let's do a definition. So mutual fund is an open-ended, professionally managed investment fund that pools money from many investors to purchase securities. So that's the idea. Now, what does that mean? What does it mean by to be open-ended? It means you can actually sell and buy whenever you like. Okay, you can join a mutual fund at whatever time you want. Right? It is not a close-ended fund. These investors may be retail or institutional in nature. Mutual funds have advantages in comparison to direct investing in securities. The advantages obviously are economies of scale, right? Obviously, a professionally run management is there, diversification, liquidity, and professional management. But the issues are there are mutual fund fees and expenses. Mutual funds are actually classified by the principal investment. So whether they work on the money market, bond, or the fixed income market fund, or the stock equity, or the hybrid funds, right? So funds may be categorized even as index funds, which are passively managed funds that match the performance of the index or actively managed index. Just to differentiate, hedge funds are not mutual funds. Hedge funds cannot be sold to the general public. That's one thing, and lack protection, which the SEBI is basically looking for. Now, what happened? So what happened was that Franklin Templeton winded up 6 schemes, and that was worth assets of 25,856 crore. So obviously the Mutual Fund Federation of India, the Association of Mutual Fund in India, highlighted the fact that while credit risk funds account for a very small portion of the overall debt assets, more than half of the assets in the debt have a rating of AA and above. Okay, so what they're saying is Franklin Templeton was one bad sheep in the overall mutual fund industry. We have no problems like that. Stay with us. So exactly what happened? Let's go in detail now. So Franklin Templeton Mutual Fund, it's the 9th largest in the country. It has jolted investors with its decision to wind up 6 yield-oriented managed credit funds from Friday. Right? This happened on Thursday and Friday last week. Now, 6 schemes: Franklin India Low Duration Fund, Dynamic Accrual Fund, Credit Risk Fund, Short-Term Income Plan, Ultra Short Bond, and Income Opportunity. So these 6 were the ones which were basically winded up. They had assets worth 28,000 crore. So that's one. That's 25%. Overall, Franklin Templeton, how much does it have? 1,16,000 crore. Now, that would actually, because of the contagion effect, people in other funds will also say that we want to sell. But okay, we'll talk about that in detail. So Fund House says that I did so because I wanted to protect my investors from the COVID pandemic, right? Because there is severe market dislocation and illiquidity. Okay, and investors are bracing for substantial losses. So we'll talk about that as well. Now, Franklin Templeton, what was the real issue, right? Why is it only Franklin Templeton and not others like DSP, etc., etc.? So the reason is that Franklin Templeton put money in less known, low-rated firms. So what it did was, with 30,800 crore investor money stuck in 6 credit funds of Franklin Templeton, it has emerged that the fund managers of the schemes were hardly conservative. They invested over 15,000 crore in severally low-rated debt schemes and lesser-known companies. So after this scam happened, BNK Securities, the financial services group, they said that they subscribe for 100% of the issue size of at least 26 cases. And this means at least 26 cases which had collectively raised 7,697 crore. They were fully exposed to them. They were the only subscriber. Now, this raises question about the investment practices of the house. So, why do you say so? What's wrong with, them being the only investor? Maybe they have some insider knowledge, you might say that. But the idea behind mutual funds is diversification of risk. And when you are the only subscriber, you have not diversified the risk. It's like you having a beta of, 1, which is not good. Okay. Now let's move ahead. So which are the following companies? Just for example, SL Infra Projects is there, right? Hero Wind Energy, Hero Solar Energy, Renew Solar Energy, and Pyramid Capital and Housing Finance, right? Greenco Clean Energy, etc. Now, moreover, what other problems they created for them? They also subscribe to certain others, all right, where there was 70% of the issue size, and there is 7,661 crores in that. So that's very odd. It's a very shocking investment pattern, right? And they're putting all eggs in one basket and they're destroying investor wealth, right? And this is Pavan Dharni Dharka. He's a BSc dealer. He says this doesn't happen. Okay. Now, so let me try to explain how mutual funds work, right? So the idea is there are 1.21 billion people, and let's say in India, and let's say 1.5 crore people invest in mutual funds. Now, they're investing in mutual funds, that's fine. Let's say they have a ticket size of let's say 1 lakh to 10 lakh rupees they're investing. Okay, right? And let's say I am IMPRINT mutual fund. Okay, and I say, okay, give me 1 lakh, I'll try to return good money to you. Okay, so what's the idea behind having 1.5 crore people investing 1 lakh rupees in me? So that means I have 1.5 lakh crores on me. Okay, let's say all of them invest 1 lakh rupees in me. Okay, so the idea is because there's so many people, okay, I don't have redemption risk. Okay, so no, I don't expect all 1.5 crore people to come and ask me for money. So there's diversification risk on the liability side. That 1.5 crore is my liability. On the other hand, let's say I'm investing in various companies. Okay, so I don't invest 1.5 lakh crore in Reliance Jio directly. I can, but I don't. The idea behind is that I will invest in 100 companies, let's say, or maybe let's say if I have been given 1 lakh rupees, so let's say I should be actually investing in something like 10,000 companies, or maybe something like 1,000 companies, let's say. Okay, so let's say if I'm investing in 1,000 company, so obviously what will happen is even if a few companies fail, I still have the return from the other companies, and I will have a good corpus, so I can return money and actually make a killing for myself as well. Okay, so that's the basic idea behind a mutual fund. Now, industry insider says that there'll be obviously certain I'll be tempted. So obviously if let's say I have 1.5 lakh crore. So obviously I'll put let's say 20 to 30% in government securities, AAA rated bonds, etc. Okay, private, etc. Then obviously I'll go for AA, right? Okay, because they give me a higher rate. And then a certain portion, let's say 10 to 20%, I will be doing risky things with them. So normally what happens is, right, that I am allowed to fully subscribe also. Right, I can actually put all my money in Reliance if I want to, but I don't do that. Okay, so according to industry insiders, while schemes are technically allowed to subscribe to papers issued by a particular company, investor needs to watch out for the risk. Okay, if 25 to 30% of the portfolio is of the company where the fund house has fully subscribed the issue, it only builds risk to the portfolio. So obviously not a good strategy what they did. It actually is very, very shady. It seems it's as if it's money laundering. Did the report also raise concern over the high exposure to the non-AAA rated paper by Franklin Templeton in funds other than the six in question as well, right? The total size of credit funds as a category defined by SEBI is 55,436 crores. Franklin Templeton, right, has been the leading managed credit category and has high exposure in non-AAA and other categories of funds as well. And that tells you that obviously, there's a huge problem, right? The reason for winding up the six funds is illiquidity in the portfolio. Okay. Now, what will happen? Will I get my money and so on? So the maturity profile, obviously, it says that it might be a lot of time, right? Some of the bonds would mature between 3 to 5 years. Others would mature between 2 to 3 years. So obviously, even if I want my money today, I'll need to take a haircut. So this is there. Uh, what is the reason behind this problem? Deepak Jasani, right, HDFC Securities, he says despite categorization by SEBI, a lot of debt schemes take risks that are not reflected in their scheme riskometer or the category names. Fund managers, in a view to generate higher returns, tend to take risks in portions of their investments, right, permitted even in the safe low risk category. So they may be risking it a little more because they feel the environment is good. Okay, so what happened? The next day, the mutual fund investors panic sold after Franklin Templeton crisis. The mutual fund industry saying not all eggs are bad in our basket. We have AAA bonds. We can redeem. Do not sell. Right? There's no need to. On the other hand, Franklin Templeton chief says, Jenny Johnson, she says she's proud of her team in India. They took quick decisions to protect the investor in these funds, and it's fine. Sanjay Sapre said that the decision to wind up was extremely difficult, but we believe that it was necessary. Okay. What does it mean? Okay, so it essentially means that Franklin Templeton will liquidate the assets and then return the money to the investors. The issue is the market situation is tough. Investors may not get an immediate exit, and it will be difficult to find a buyer for the low-rated asset in the portfolio, and the investors might have to wait. And the other is obviously if you try to sell, it would lead to a substantial haircut. It would mean a big loss on the investors on the capital investment. So as one investor put it, investors will pay a heavy price for the incompetence of the fund house. The fund house, on the other hand, says it's because of the COVID and a lockdown for the failure in managing these assets of investors. Now, the question, obviously, big question, is that will it affect other mutual funds? Right, the fund house says, we have equity, debt, and hybrid. They are unaffected by the decision. There's not a problem. The Association of Mutual Fund in India says not a problem. We have good AAA assets. We have AA assets. We're going to have not a problem. But obviously, there's COVID and the lockdown. If it continues, I would definitely feel that even the AAA bonds will get downgraded. Now, just to have an idea, I think a lot of you might have read this term while discussing the Franklin Templeton case. What are credit risk funds? So this can be asked in your RBI, right, or banking exams, or even UPSC. Okay, so credit risk funds are debt funds that play on the principle of high risk, high reward. By definition, credit funds invest 65% of portfolio in bonds that are AA rated or below. And investors must be aware that they are investing schemes that are investing in low rated papers. Right. While obviously the reason is that if I go for AAA rating, they're secure, but they offer low interest rates. So the credit risk funds generate, high return, but they have higher risk. Okay. Now, obviously, this Franklin Templeton closing down these funds would lead to breaking investor confidence in these mutual funds. The question is, why are they risky? The risk basically has been because of the high yield, right? And the fund managers themselves want that they get some bonus. So that is the major reason, the greed, right, in simple terms. Okay, they have been chasing high yields, obviously ignoring the higher associated return. When the external environment was good, the economy was witnessing high growth rates. There was no undue pressure on liquidity. There was not a problem. But now there is stress in the economy. It's difficult to raise funds. So obviously now we would have problems. Borrowers will not have not been able to service any interest payments and principal payments as well. So now the question becomes how important was the role of the fund manager, right? So the fund managers actually can lower risk by following a higher diversification strategy. If the scheme is diversified significantly on the asset side, right, that is, the exposure is not to a few companies, even if this default by one or two, the entire portfolio does not get affected. Similarly, if the scheme is well diversified on the liability side, even if one of two investors seek a redemption, it does not push the fund house to sell. Now, the problem is they did not follow the simple principle of diversification. Now, should investors worry about their credit funds and other houses? Kotak Mahindra fund, Nilesh, Nilesh Shah is saying that not a problem. We have good investments. He says, in fact, majority of the credit funds has been a significant movement towards better quality assets, and this happened after the ILFS, right? So not a problem here. Milind Barve, who's from HDFC, he says it is not an industry of credit category problem. Retail investors should not problem. It's just a one-off incident, and they should look at carefully at the portfolio of credit funds in future, not maybe invest in them. Right. The idea is that the economy is facing a serious challenge because of lockdown, and several companies are struggling. It is time for investors to look at the quality of companies where the investments lie. Right. If their investment have exposure to debt and equity of low-rated companies, we must consider reallocating them. Now, this is from today's newspaper in the Morgan Stanley. It says that debt funds have less exposure to risky issues after the ILFS fiasco. Recent events, have increased the risk of redemption in debt funds, but a gradual reduction in exposure towards riskier issues towards the last year and a half could limit further downside risk. He says maybe not a problem anymore. What was the government's reaction to this crisis? So the RBI basically, announced a special liquidity window of 50,000 crore, and it was to bail out the turmoil in the debt fund, because there's a risk of redemption, right, by mutual funds. So obviously they would need money. In April itself, the mutual fund industry had a redemption of 1.94 lakh, and this might be true because of the fact that a lot of people are now losing jobs and so on. So how does a liquidity window work? So what will happen is that RBI for 90 days, okay, right, this is a short term, will give 4.4%, that is a repo, will give loans worth 50,000 crore to banks. Okay, right. Now, obviously, the tenure is at 90 days. Now, the banks will just give it to mutual funds, and for that they would take collateral, right, of investment grade corporate bonds, commercial paper, debentures, certificate of deposits, etc. Right. Now the question is whether this will work or not, right? But the interest rate is decent and so on. Why has the RBI offered this facility? This heightened volatility, as we talked about, due to COVID, the liquidity strains on mutual funds, which have intensified due to redemption pressure, and also Franklin Templeton has potential contagious effect. And the stress is confined to the high-risk debt fund segment of this stage, while the larger industry remains liquid. The RBI's liquidity offer is expected to bring some degree of comfort in the debt market, and there is huge redemption pressure, especially in the credit risk funds which have assets over 55,000 crore, and that's why they've said that 50,000 crores. What are the features of this offer? The RBI has done a good job in actually talking about it. They said this facility will not be reckoned under the large exposure framework, right? So large exposure framework is under which you can be exposed to a certain segment. Okay, so 50,000 crore is a large number. It would increase the number of percentage points for the mutual fund industry in the exposure framework. Further, the face value of securities acquired under the SLF-MF will be kept in the HTM's category and will not be reckoned upon for computation of adjusted non-food bank credit, and for the purpose of determining priority sector targets. So, I don't have to worry about, the other loans. So I still can give other loans if I do this. The support extended to mutual funds under the SLF will be exempt for the bank's capital market exposure limits as well. So that's good. So, they're actually, the caveats are fine. This is the editorial today. This editorial is talking about the fact that the RBI liquidity facility for mutual funds still hinges on the bank's willingness to lend. So it says that if the recent experience of getting lenders to support non-banking financial companies through a targeted long-term repo operation by 50,000 crores any pointer, the banking industry is beset by bad loans. They have little appetite for any credit, right? the banks, how willing they are to use this facility, right? The economy is in lockdown. The credit ratings of even well-established companies are facing a real and not so distant threat of downgrades. So the center might need to intervene directly if the RBI gambit, right, fails to ease the pressure on mutual funds. Now, what does UK Sinha says in the editorial? He talked about that what has happened is that there's very little appetite for investment grade securities now. The state development loans of 37,500 crore were put for auction on April 9th, right? In that week, they had to be either cancelled or reduced, and they gave a yield of more than 70 to 75 basis points higher than the previous day. Even the highest rate PSU bonds, REC had to withdraw one of its issues. NABARD could not get the full amount it has sought. AAA private issuers had also faced similar issues. So there is a debate whether the market has a risk appetite anymore. So the liquidity released by the RBI is not just reaching the desired beneficiary. Banks instead have parked huge amounts with the RBI in reverse repo. Insurance companies are reportedly out of the bond market, so there's no secondary trading of the bonds. Today, no HFC, that is housing finance companies, getting repayment from home buyers loan. No SME is able to service as NBFC loans. No MFI can hope to get any repayment from its low income borrowers. Banks are reluctant to lend and refusing to comply the moratorium facility to it. Right, so this is a huge problem. So the banks can obviously swiftly this problem now can swiftly migrate to the financial services sector and spread to the real economy. Obviously, the real problem is people might worry about the fact that even their honest mistakes will be punished by the CVC, the CBI, and the CAG. The All India Manufacturer Organization says if lockdown extended, 25% of all companies, MSMEs, will close down. Right, and McKinsey says that if there is a 25% default, the solvency issues will start off for the entire financial system. Now, what are the solutions, right? So Uk Sinha, being the SEBI chairman, does give us some solutions. He says after having rightly focused on the spread and social protection, now we should focus on the economic revival and job protection. We have to unclog the financial markets. RBI has to ensure that the targeted long-term repo operation money reaches the deserved NBFCs, the HFCs, the MFIs, and the MSMEs. And there should be a willingness to enhance the target amount as and when needed. There has to be very clear directions for monitoring, credit enhancement to cover the first loss or credit guarantees, issuers of tax-free bonds providing equity to stressed MSMEs through special SPVs, directed corporate bond buying by the RBI. These can be done. These might be drastic, definitely, right? But if you do not it is advisable, right, to take them up sooner, else the pain will aggravate and ultimately become more expensive for the country. The thing is with this, if you issue tax-free bonds, you provide equity to stressed MSMEs, to SPVs, direct corporate buying, what will happen? There'll be mistakes. There has to be tolerance for such mistakes. Right, and this has to be properly communicated to the bankers and the civil servants. So you have to be told that the CAG, CVC, and the CBI will not come after them. So the economic revival post-COVID requires active coordination between the government and the regulators. SEBI RDI will have to play a part in ensuring normal functioning of the industries they regulate. Right now, whatever rules they have is for peacetime. They need to make COVID time rules for regulation. There have been instances in the past where if they have a better coordination, we would have efficient returns, right? But coordinated action is a need of the current war-like situation. Pandemic has exponential characteristics. Remember, linear solutions will not work. And Uk Sinha says we have to be nimble, take calculated risk and newer approaches, and should be prepared to renew and redesign our efforts and steps as things unfold. Thank you so much for listening. Do like and subscribe. Join our Telegram group for the PDF of this video. Thank you so much.